I'm back with a case study. This is part 2 of a $20 million plus optimization strategy. So let me be clear. I know a lot of you don't have $20 million, and there's lots of content out there for people that have 500,000, a million, 2 million. A lot of that content is from me, but there are 100,000 people in the United States that have north of $20 million that are also not getting optimal guidance. Now I can hear some of you already going, don't they have enough money? Aren't they going to be fine? And look, I'm all about helping people who have a $1 to $100 million. And too often people get ignored who are in this category of $20 million plus. So if you're watching this right now going, I want to see how you would help someone with $20 million minimize taxes, keep watching. If you're like, look, I get you're helping out these people with tons of money already, but that doesn't apply to me. Have something else a little bit more my speed. You can see I have, no matter where you're at, I have a video if you have 500,000 bucks. I have a video if you're in your 30s starting out. I have a video if you have $5 million. I just want to help you where you're at. But some of you have expressed, hey, a lot of your videos are helpful and I see you have a lot, but I'm in this unique position. What should I be thinking about? So I'm going to keep it entertaining. There's going to be a few things I can almost promise you've never heard of before. And if you are the person going, yep, that's me. I've got 10, 15, 20, 30, 40 million bucks. I need help. Hopefully this is helpful for you. If you have not seen part 1, it's not a requirement, but I start explaining the couple and who it is we're talking to and what assets they have and how do we save on taxes. This is going to be a deeper dive on specific strategies that your advisor should be portraying to you if you want to truly optimize, and generally you have north of $10 million, this stuff makes sense. So here's where I'll start a conversation. I'll pull up this on my screen. Now, this is a big, often overlooked aspect of planning, which is we could have something that's so tax efficient, it's incredible, but it's complex and it's rigid. And yeah, we have something and technically it's optimizing our taxes, but to be honest, it's just such a pain in the behind that it's not worth setting up. And yes, you can get access to it, but it's not liquid. So it's like there's a reason people have money in a bank account because you can tap into it. Now, it's not that hard to go to your investment accounts, click sell, wait for it to settle, send money to your account. But by that time, you're like, look, I don't want it anymore. Now, if it's a big purchase or you want to make sure your money is outpacing inflation, like, yes, of course, make sure your money's working for you. But there's a balance between something that's so tax efficient but it's so complex or so rigid, which I'll see someone in private equity, or they're in credit lending, or they're in some different securities investment, and it's so complex and it's going to give them a 20, 30% return, but it's not liquid for 5 years. So yeah, it could be a strong investment. It could play a role in your portfolio. Should it be the majority? Probably not. Then there's people that are just simply, it's flexible, you can get it, but it's tax inefficient. The example I'll give here is Vanguard. Now, I like Vanguard, so let me be clear. For lots of people, Vanguard is awesome. I personally had Vanguard for a long time, but there's a company I like better called Dimensional. Now, I don't work for Dimensional, so I could care less if you use them or use Vanguard. I just care that you're optimizing. And Vanguard is a company that is great, but everyone's at Vanguard. Not everyone, lots of people are at Vanguard. So think about Vanguard like the dollar store. That's where you can go, you're going to be able to eat. Is it the best quality? Maybe not. Think about something that's super complex and rigid. Well, if it costs us a lot of money, it's not worth it. It's like, don't go to Whole Foods to buy paper plates. It's just not worth it. But there's a balance in here. So one of the things we're going to talk about today is called a separately managed account. Many of you have never heard of this. This is something I specialized in at my previous firm called Nuveen. Nuveen is a tax shop. Now, what is it? You don't just like go there and buy taxes. It is a specifically municipal bond shop. So my job was to help people create tax-free income in retirement. That's what I did. Now, I was helping institutions and talking in high-level conferences, and it just didn't feel one-on-one. So didn't love it. But you can see here, an SMA does not make sense for lots of people. Let's assume that you have $10 million in a 401k. You should not do anything I'm about to tell you right now. Let's assume, like the couple that we're discussing, you can see here, they have lots of different things. They have a 401k, they have a Roth 401k, they have an IRA, they have a brokerage account. You can see this couple, of which they have a $20 million net worth, 14 million liquid assets, 9.3 is in a brokerage account. The brokerage account, that is after tax dollars. That is money that you have. You've already paid taxes on it. This couple sold a business. So what on earth is a separately managed account? Is that like a Roth or a brokerage account? No, entirely different. This is a personalized mutual fund or ETF tailored to your specific tax, portfolio, and financial goals. It's a key benefit for proactive tax management. So does everyone need this? No, no, no. But let's assume that you want to go to the store and you're going to buy rice, okay? And let's assume you decide you want 10 things of rice. I don't even know what it's called, 10 pieces of rice. You want 10 little things of rice. You could try to carry 10 pieces of rice and go check out. Or you could go, I'm going to buy a bag of rice, and the bag of rice is going to hold it. Think about a mutual fund or an ETF. That's like a bag of rice. You're holding rice. It's an efficient way. You're still going to get to eat it. Doesn't change how much you eat, but you get to hold it, and it's easier, and you can be like, yep, I have a bag of rice. Versus imagine you have 100 different individual stocks. If you have 100 stocks, imagine trying to hold 100 little things of rice and going to the checkout. And you know what they would do? They would laugh at your face. That's what they would do, okay? Now, I wouldn't laugh at you because I'm not like that. I'm different, okay? But just kidding. I'd probably laugh a little bit. I'd go, that guy's a little weird. So 100 little things of rice, okay? Now, let's assume that's kind of basic level 1 example. Level 2 is going, okay, so if you're telling me I shouldn't have the little things of rice, individual stocks, but I bought Apple stock for $1,000 and now it's worth $5 million. I don't really just want to go sell it. And if I sold it, I kind of understand I'd be diversifying, but I'd just be paying so much in taxes. I don't know if it's even worth it. And I'd say it's probably not. So then I'll tell someone about an ETF or a mutual fund. And they're like, yeah, I get that. But once again, I just told you, I bought this thing for $1,000. It's worth $5 million now. I really don't think I should go diversify. And I go, you shouldn't. You should maybe look into an SMA. And they're like, what's that? And I go, an SMA, you own individual securities. So you still have your little 100 pieces of rice. You didn't sell it, okay? You own your, Apple and Amazon and Netflix and Nvidia. Now, it generally makes sense because of the type of product it is if you have $500,000. Now, I'm talking 500,000 generally in like significant gains, or this isn't going to make a lot of sense. Now, there's a fee to own this. Ooh, we don't like fees. I'm very fee conscious. I'm a very transparent guy. Oftentimes, the fees are not worth it in investments. Oftentimes, annuities, I don't like. Insurance products, I don't like most of them. Some of them play a role. But this is one where it only makes sense if we're hitting all these boxes, and then it makes a lot of sense. Highly personalized strategy and design. Best for accounts with large gains. Reinvest without selling all holdings. Think about it like this. Let's assume you have Amazon stock. You bought it for, let's say, $1 million. It's now worth $5 million. But you also have all these other positions, okay? You have Google, and you have Meta, and you have Shopify. But let's assume they haven't done well for you. If you were to just go diversify, you would have to pay a lot of taxes because you have the big gains, you have some other losers. It's not a customized thing. A separately managed account is almost like your own ETF, where you get to actually go diversify, but you don't have to go sell all the holdings. So let's say you have a ton of winners with some really big gains and a ton of losers. Well, you don't just have to go click sell on your mutual fund and just gets diversified. You don't have to go, I'm just going to sell Apple. You can decide, I'm going to sell this portion of Apple. Let's assume you're holding 100 pieces of rice. 10 of them look a little moldy. Well, just get rid of those 10. You can't normally do that with investing. With an SMA, you get to fully customize what planning looks like. Now, when does this make sense? If you have highly personalized strategy needs, so tax planning, if you have a big account with gains. If you don't, and most of your money is in a 401k and you're 60 and you got $2 million, you don't need this. This is unnecessary. Let me show you a quick example as to why someone might do this. Let's assume you have $4 million and they're all individual stocks and it's just in a brokerage account, not a Roth, not a 401k, not a HSA. I've never seen $4 million in an HSA before. I've actually never seen more than $200,000 in an HSA before. But let's assume you have $4 million in a brokerage, or what I call a superhero account. Now let's assume 2 million of it is unrealized gains. So 2 million cost basis, 2 million gains. We can intentionally set that we want this strategy to realize 200,000 of gains, just as an example. Now we want to determine what part of the portfolio we want to be in US stocks versus international versus emerging versus real estate. So let's assume we target a specific percentage and we want 56%. If the account is able to realize, and I know I'm nerding out here, but if the account is able to realize 5% in tax loss harvesting on average every single year, that's 200,000 per year in losses they can bank. So they can save those losses and offset them as they see fit. That is tax planning. Now imagine in 1 year there's 10% losses. Well, you could bank 400,000 in losses and just offset those to all those other gains. Now what you don't want to do is go, well, that's going to cost me taxes. I don't want to sell it. How do I think through that? Don't let the tax tail wag the life dog, because the reality is if that one position in a single day could go down $40,000, you don't want to avoid diversifying because of taxes. You just want to be aware of it. And depending on markets, if you think of it, could go down theoretically 10% in a single day, which could have wiped out all the gains. Now, is that realistic? No, but it could, and I want to protect against that. I'm not saying it's an Enron situation. I'm not saying it's another dot-com bubble. I'm not saying 2008 is about to happen. I'm saying when I don't know what's going to happen, I don't want to hope you get lucky. And if you don't, well, that really changes your retirement. And if you have 2 million of healthy gains, could we diversify them and maybe buy more, but just reset your cost basis? That might be attractive. So now assume that it's a $10 million account, $15, $20, $30 million account. I'm just using 4 million as an example. The higher the gains you have and the more positions, the more opportunity to optimize. So let's go in deeper, but first let's understand this. A lot of advice can be quantified. So for example, this is a sheet we put together through the use of a third party as well, just quantifying the value of advice, doing different tax strategies, investing, withdrawal, estate. Some of these things can be easily quantified. Choose the right Social Security decision. Some of these can't be quantified. Determine when you can stop working. I'll tell you, most people are hiring us to not have to do any of this. They're paying for their time. They would rather spend their time doing whatever it is they want to do than financial management. Now, most people are going, yeah, I want to do that, but I want to make sure it's worth it first. That's what I would say. So you can see here, eliminating catastrophes, priceless, and ensuring things get done. This is just a quantification of planning. Now we have a similar thing for an SMA. So you can see here, what are the different benefits? Income management. So an SMA can exclude REITs. REITs are real estate investment trusts. So these REITs are often not tax efficient. So REITs will have ordinary income. And there's a lot of different things around REITs that don't make them tax inefficient. Doesn't mean they're bad, but if we want to optimize, we want to understand, when are we trading? How does that impact dividends? And how can we increase the amount of dividends that are qualified, because there will be less taxes? Optimizing gains. Can we sell investments in a tax efficient way, intentionally delay a certain gain because you have a position that's done really well, and still build a portfolio that's diversified without triggering large taxes on existing gains? I'll be honest, this is the main reason I use it. This is another huge reason. Tax loss harvesting. You can choose in your SMA to go, I want to have my tax loss harvesting happen at this tax bracket. I want to intentionally sell this at this time and be more active as an investor. I want to have more of a say in terms of the tax loss harvesting, rather than if you own a mutual fund and it either for you specifically isn't going to be most applicable because it doesn't know you. It doesn't know when you want to retire. It doesn't know your situation. This is an account that is taking into account, I know I just said it twice, everything else you have going on. So if you, for example, have a target date fund, to keep it simple, at your 401k, and let's assume you pick the 2030 target date fund because that's when you want to retire. Well, that target date fund is going to get conservative early. Why? What if everyone's in a 2030 fund and markets do poorly? Well, Fidelity, you're going to get mad at Fidelity because you're going to be like, I was in your target date fund and my funds went down too quickly. Their bias is to go, let's not have people mad. I know people could make more money if they invested differently, but let's just be conservative, and we're going to make the portfolio get really conservative before someone retires. But that 401k that you're invested in with the target date fund, it does not know that you don't have children that you want to leave a legacy to. It does not know that you might have 5 million in other assets that allows your 401k to invest more aggressive because you're not going to touch it first because you have a brokerage account. It doesn't know that you might have rental properties. It doesn't know that there's a pension. It doesn't know inheritance timing. It doesn't know a lot. How could it know? So the point here is it's just not a custom strategy. You're leaving money on the table. Now, there's lots of different metrics here in terms of return changes it could have, but it's not as if it's, hey, you invest in this and you get this. There is an optimal way to manage an SMA, and this should be a specific thing for your strategy. So I can't come out and say, I'm going to guarantee it's going to let you X amount in taxes. I can say, hey, for this particular couple that works with us that has $8 million, they're wondering, should I do an SMA? And we showed them, here's all the tax planning. Here's what would be involved in this. And they go, well, that's a no-brainer. I mean, if that's going to save me $40,000 to $60,000 a year in taxes, then I don't see why I would not do this. So SMAs are an amazing tool, often underutilized in planning. Now, so far, if you're like, I don't even know what you just said right now. Like, I know you were talking about SMAs, but you lost me at the rice, and like, are we eating rice together? Like, what are we doing right now? What I want you to understand is when you generally have $10 million plus, you don't just have an investment issue. You don't just have a tax issue. You have an estate issue. And estate planning is the next aspect of planning that people overlook. So here's this same couple, John and Jane, and they're on track to have $100 million. They don't want $100 million to go to their heirs. So they're like, what the heck do we do? Well, do we give more to charity? Do we do it through a donor advised fund? Should we buy more life insurance? Like, what do we do? I'm not going to bore you to death and go through every single type of estate strategy here, but my fun example here, and I've given it to you before, is someone came to me and they said, Ari, I watched a video on YouTube. I have north of $5 million, and they said I should have a charitable trust. So I got one, but it didn't work. I said, why didn't it work? They said, it just doesn't work. It's just, I can't believe I fell for it. I was on YouTube and it sounded so good. And I said, look, they all work. It may not have worked for you. Heart medication doesn't work for me because I don't need it. It is great for my dad. I want to ensure no matter where you're at in life, you're buying the right either product or using the right investment because it's applicable to you. It's difficult to know what strategy. Should we use a charitable trust? Should we instead get a Q-tip? Should we do a Q-PERT? Should we use a donor advised fund? What different instruments should exist for our plan? Estate planning, I'm going to be doing a webinar on going over the major benefits of most of these in the future. But what I want you to know when you're doing planning for your situation is, what does the estate planning mean to you? Would you rather be giving more today? Would you rather, and I'll give you this example. I had a couple, I said, sorry, something in my eye. I had a couple, I should get so teared up about this stuff, guys. I had a couple, I just said that, 4 times? I won't say it again. They have, I'm trying to think because it's not this couple here. I think they have about $16 million. Majority of it is in after-tax money. They have some in a brokerage account, inheritance. Oh, by the way, do you guys know what I call inheritance? And actually, I don't call it this. A previous mentor says, if you have inheritance, you're part of the lucky sperm and egg club. Sperm and egg. Yep, we got to keep it fun at the same time. Okay, so the point here is I asked a couple. It was this couple. Guys, is charitable giving why you're on planet Earth? And they're like, no, and you already know that. I said, I know, but if I told you there would be a tax benefit to doing this strategy versus not doing it, meaning if you hated charitable giving, which I've never heard anyone hate it, but if you hated doing it, the whole concept of volunteering and giving to charities, if you just don't like that concept, but this would show you less tax dollars you'd have to pay, would that be of interest? And they're like, well, I just don't see why not. I said, great. That is the benefit of doing quality tax planning, quality estate planning. There are financial benefits to doing it versus not doing it. So I want you to explore in more detail what estate planning means. There are so many different strategies that exist in this field. Charitable trusts, donor advised funds, ILIT, which is an irrevocable life insurance trust. So many different things here. Today, I'm already at 15, 20 minutes, which is what I wanted to do. So the SMA took up the majority of this conversation. This is where it's going to end in terms of just high net worth, ultra high net worth, 20 million plus, like optimization strategies. If you're looking, going, yep, you know what? This was helpful because this is me. I've got 10, 15, 20, 30, 40, 50, 100 million bucks. What do I do? I encourage you to reach out. We have a few advisors here that specialize in ultra high net worth planning. If you're like, hey, this is really cool, I don't think I'm ever going to need this stuff, but this was interesting. Please like this video. Please share this video. If you're like, you know what? I kind of see what you're bringing up here. I don't think I'm going to need that, but I'm going to actually do this other tactic that I found because it's going to lead me to not having to worry about this in the future. Great. No matter where you're at, if you've got 500,000, a million, 20 million, I just want you to get good guidance. So if you don't have $2 million, which is the minimum to work with us, you can get the access to the academy with the tools and the strategies that I'm talking about right now. If you're like, you know, I want to work with you guys because I just don't want to do this anymore. I just want to make sure it's a financial value for you and it's a win-win for both of us. So I'd encourage you to schedule a call with us and let's find out, does it make sense or does it not? That's it for this part 2 of I have $20 million. How do I optimize? Hopefully this was helpful.